Picture this. You're a gold trader. You've done everything right. You bought at the right price, stored your reserves properly, and positioned yourself perfectly for a market upturn. Your gold is sitting in a high-security vault in Dubai, one of the most connected financial hubs in the world. Then, war breaks out. Suddenly, the airspace above you is declared a no-fly zone. The cargo flights that were supposed to move your inventory, grounded. The insurance premiums on your holdings, they just tripled overnight. And every single day your gold sits in that vault, you're bleeding money. Storage fees, financing costs, opportunity costs, all stacking up while you watch your carefully planned trade slowly unravel. So what do? You sell, at a discount. $30 below the London benchmark price, nearly $1,000 per standard kilogram bar, just to stop the bleeding. This is not a hypothetical. This is what is happening right now in Dubai, and it fundamentally changes the conversation about what a safe haven asset actually means in the modern financial era. Welcome back to the channel. Today, we're going deep on one of the most important capital flow dynamics of our time, the evolving relationship between gold and Bitcoin during periods of geopolitical crisis. Stay with me, because this one will genuinely change how you think about preserving wealth. To understand why this matters, we first need to understand Dubai's role in the global financial ecosystem. Dubai is not just a destination for luxury tourism and skyscrapers. It is one of the most important commodity trading hubs on the planet, a geographic crossroads connecting Europe, Africa, and Asia. When gold moves between continents, there is a very good chance it passes through Dubai. That is by design. The city has built world-class infrastructure specifically to facilitate the movement of high-value physical assets. But here is the thing about physical gold that most retail investors never fully appreciate. Its circulation depends on a highly specialized and surprisingly fragile logistics network. Think about what it actually takes to move gold across borders. You need specially modified cargo holds on commercial or chartered freight aircraft. You need armed security teams on the tarmac. You need insurance coverage that, for a single flight, can run into the hundreds of millions of dollars. You also need trusted intermediaries at every stage of the process: brokers, custodians, clearing institutions, and regulators, all functioning simultaneously and efficiently. When that system works, it's a remarkable piece of modern financial infrastructure. But when war breaks out, that entire system can break down almost immediately. Airspace closures, dangerous flight corridors, grounded cargo operations, insurers withdrawing coverage, or dramatically repricing risk. The result is that gold, the asset many people buy specifically because it is supposed to preserve value during uncertainty, suddenly becomes extremely difficult to move or sell. Many buyers have canceled new orders entirely, unwilling to absorb the skyrocketing shipping and insurance costs. Unable to guarantee delivery timelines, traders are choosing to sell at a discount rather than continue absorbing holding costs indefinitely. That $30 per ounce discount is what analysts are calling a reverse war risk premium, and it reveals something profound about the nature of physical assets. In the worst possible moments, the exact moments you bought gold to prepare for, it can become a liability rather than a lifeline. Let's break down exactly why this happens, because understanding the mechanics here is crucial. When war breaks out in a region that intersects with major gold trade routes, three cost categories surge at the same time. First, insurance. Maritime and aviation insurers, including major markets like Lloyd's of London, apply what are called war risk premiums to coverage in conflict zones. These aren't small adjustments. We're talking about cost increases that can erase a trader's profit margin within days. If you're leveraged, which most institutional gold traders are, you can move from profit to loss extremely quickly. Second, storage. House security vaults in financial centers like Dubai charge daily custody fees. These costs are manageable when gold is moving efficiently through the system, but when gold becomes stranded, every single day adds to your cost basis, and there is no revenue coming in to offset it. Third, opportunity cost and leverage. Most professional gold traders are not operating with purely their own capital. They are using borrowed funds, which means they are paying interest on positions, whether those positions are generating returns or not. When gold is trapped and illiquid, borrowed capital sits idle while interest continues accumulating. The rational response to this triple pressure is to sell, even at a discount, because the alternative is to continue losing capital with no clear timeline for resolution. And this is the ultimate irony. Gold's entire value proposition is rooted in being the asset you hold when everything else is falling apart. Yet the very conditions that cause everything else to fall apart are the same conditions that make gold hardest to move, most expensive to hold, and most likely to be sold at a loss. For central banks with armies and naval fleets to protect and transport their reserves, this is manageable. For individual investors, businesses, and people caught in geopolitical crisis zones, gold's physical nature can become a serious vulnerability. Now, before we talk about Bitcoin, I want to be upfront about something because this channel doesn't do hype and this topic deserves intellectual honesty. Bitcoin is significantly volatile. When geopolitical crises erupt and panic spreads through markets, Bitcoin does not behave like a traditional safe haven in the short term. It often sells off alongside equities. Investors in risk-off mode liquidate everything, and Bitcoin, still categorized by many institutional players as a risk asset, gets caught in that wave. If you're evaluating Bitcoin purely on 30-day price stability during a conflict outbreak, gold will often outperform it in that narrow window. That is simply the current reality of how markets price these assets. But here is the critical distinction that most mainstream financial commentary misses entirely. Volatility and transferability are two completely different dimensions of value. And when we're talking about a genuine wartime crisis, not a market correction or a recession, but a situation that physically disrupts infrastructure, transferability may matter more than short-term price stability. Let me explain why. Bitcoin operates on a technical standard known as BIP 39. Remove the technical complexity, and all this means is that a Bitcoin wallet can be recreated using a 12 to 24-word recovery phrase, which acts as the cryptographic key to access the funds. Think of it like your ATM password, but longer. Your Bitcoin is not stored on your phone. It's not sitting on a USB drive. It's not locked inside a vault in Dubai. Instead, it exists on a distributed blockchain ledger maintained by thousands of computers around the world. What you control is the private key that proves ownership of those coins. Now think about what that means in the context of a war crisis. If you're holding physical gold and conflict breaks out in your region, your options are extremely limited. You can attempt to transport it, which means navigating checkpoints, border controls, X-ray scanners, and armed personnel who may confiscate it entirely. You can store it and hope, which means paying escalating fees while hoping the vault itself remains secure. Or you can sell it at whatever discount the broken market will offer. If you're holding Bitcoin and the same crisis unfolds, your situation is fundamentally different. Your entire financial position can be secured by a memorized recovery phrase, 12 words, no physical weight, no X-ray signature, no customs declaration, no dependence on cargo aircraft, insurers, or armed escorts. A war refugee crossing a border with nothing, no smartphone, no hardware wallet, no documentation, could theoretically carry their entire Bitcoin holdings in memory and restore access once they reach safety. This is not purely theoretical. In recent crises in countries like Ukraine, Venezuela, Lebanon, and Afghanistan, Bitcoin's digital portability has been cited as a financial lifeline for some individuals. Not because of price performance, but because it allows value to move when traditional financial channels are restricted. The Dubai gold crisis highlights a liquidity problem, but the broader context of geopolitical crisis raises an even deeper issue: censorship and confiscation. In modern conflicts, economic warfare runs parallel to military operations. Governments and their allies increasingly deploy financial restrictions as strategic tools. Capital controls can be introduced rapidly, preventing funds from leaving a country. Accounts belonging to political opponents, activists, or ordinary citizens can be frozen with a government directive. Physical assets at borders may be confiscated legally or extrajudicially. This applies to gold held in bank vaults, it applies to fiat currency in traditional bank accounts, and it applies to any asset that depends on a centralized intermediary for custody or transfer. The uncomfortable truth is that when you hold gold through a bank or custodian, you do not fully control it in a sovereign sense. You have a claim on it, a claim that a government or financial institution could potentially suspend. History offers many examples. The 1933 U.S. gold confiscation order under Franklin Roosevelt, capital controls in Cyprus in 2013, account freezes in Canada during the 2022 trucker protests. Bitcoin's design was specifically intended to reduce this category of risk. It runs on a distributed network with no central authority, no headquarters that can be raided, no CEO that can be pressured, and no single server that can be shut down. As long as you control your private keys, no outside party can directly prevent you from sending a transaction. Bitcoin does not require the approval of any government, bank, or airline to move value across borders. In the face of states that sometimes weaponize currency as a tool of political pressure, Bitcoin offers something historically unusual: ownership secured through cryptography rather than institutions. So, where does this leave us from a capital flow standpoint? What we're witnessing in the Dubai situation is not just a logistical market anomaly, it is a stress test, and the results are being observed by institutional players, sovereign wealth funds, family offices, and high-net-worth individuals around the world. Every time a geopolitical crisis exposes the physical vulnerabilities of gold, it adds incremental credibility to the argument for Bitcoin as a complementary reserve asset. Not a replacement, that conversation is far more nuanced, but a complement that addresses specific weaknesses that gold cannot solve. Institutional adoption of Bitcoin has been accelerating partly because sophisticated investors are stress-testing portfolios against extreme scenarios. The question is no longer purely what happens to price in a normal market cycle. It is increasingly what happens to my ability to access and move this asset if global infrastructure breaks down. Gold answers that question poorly for anyone who is not a central bank. Bitcoin answers it in a way that few assets in financial history ever have. Let me bring this home. The $30 per ounce discount happening in Dubai right now is not just a number on a spreadsheet. It is a symbol. It represents the cost of physicality, the weight, the vulnerability, and the dependence on logistics chains that can be disrupted overnight. Gold will remain a critical reserve asset. Its 5,000-year history does not disappear. But its role as the default safe haven for individuals navigating geopolitical crises is being challenged, not by speculation, but by the practical reality of what happens when physical movement becomes impossible. Bitcoin, for all its volatility, offers something gold cannot: the ability to secure wealth across borders with nothing more than a memorized recovery phrase. Bitcoin is not just a currency, but a form of property that is digital, portable, and borderless by design. As conflicts reshape the geopolitical landscape, supply chains fragment, and financial warfare becomes a routine instrument of statecraft, the asset that can move instantly across a decentralized network will increasingly compete with the assets stranded in a vault. A memorized seed phrase may ultimately prove more portable than a ton of gold you cannot move. Gold and Bitcoin are not competing assets. They are strategic levers responding to different financial conditions. Gold is asserting itself as the defining store of wealth of our era, reaching all-time highs against a backdrop of war, inflation, and institutional demand. Bitcoin is simultaneously rewriting its own narrative, no longer simply a speculative asset, but one that serious portfolio managers are beginning to position alongside gold. Understanding how these two assets interact is no longer optional. This channel is built to help you think through that decision with structure and discipline. If you found this analysis valuable, hit subscribe. We cover institutional-level breakdowns of macro dynamics and digital asset strategy every week. Drop your thoughts in the comments below. Do you see Bitcoin as a genuine wartime safe haven asset, or is the volatility still too much of a barrier? If you want to be ahead of the curve, follow this channel.